the format has been given credence by Neville Noronha himself, and he's even in the con call transcripts he's said that it's a much smarter format, and this actually is very very apt for the Indian market rather than the developed market. Good evening, everyone. Hi. So I'll start with today's presentation. Thank you for coming. Just take a note of the next two FOF dates, 12th November 2024 and 11th December 2024. So today we'll be talking about quick commerce. I think it's a very topical presentation, especially now that the Swiggy DRHP is also out. So we'll only be focusing on Zepto, Instamart, and Blinkit. Food delivery is something we've covered in the past, so there will be some parallels that we can draw from that business. But again, this business is quite different in that sense. So why has this been in the news so much? So Adit Palecha, he's the founder of Zepto, and recently in an article in July 2024, he mentioned that Zepto will be almost bigger than DMart within a year or two, and this is just so it was founded in 2020 itself. And something interesting that I learned was DMart was founded at a time where Adit Palecha was just 8 months old. So to hear that from a young guy, 22 years old, that he's going to be bigger than DMart, which is a very respectable company, right? And it took them almost 22 years to reach $35 billion. So him targeting a $50 billion kind of a valuation within 4 or 5 years is just unheard of. So again, unless you actually read into what is this business and why it's working, or why is there so much optimism around the business. So the format has been given credence by Neville Noronha himself, and he's even in the con call transcripts he's said that it's a much smarter format, and this actually is very very apt for the Indian market rather than the developed market. So we'll look at why that is the case. So just a quick raise of hands, how many of you would be willing to pay 50 rupees if it saved 30 minutes of your time, effort, energy? Yeah, I think almost everybody. So that itself establishes the use case for this business, right? The entire premise of the business is saving your time and energy rather than having to go down and get the products, especially at the last minute when you may be in a hurry, anything like that. So just a quick structure of the presentation, how I'm going to be presenting this. So we'll talk about the quick commerce business and revenue models, basically how this entire business works. Post which we'll have a quick look at how the dark stores also operate and their unit economics, because that's a very important part of the entire business model. After that, we'll go through the why there is so much optimism, so the bull case, and some of the challenges in, at least according to me. Yeah, so that is largely the format of the presentation. So just a brief history into the entire retail industry. And these are the different retail formats in the modern world today. So in the Swiggy DRHP, they term this chart as a evolution of retail in India, whereas I beg to differ slightly. So it basically goes from traditional mom and pop stores to modern trade, which is your e-commerce, large format stores rather, e-commerce, slotted delivery, upgraded slotted delivery, which is same day delivery, and quick commerce, right? So the reason I beg to differ is, in my opinion, all these formats have a use case and all will coexist It's just the proportions in which they'll coexist is the bigger question, right? So this is how the entire industry has evolved and why there are so many different formats today. Uh, but these are not the only formats that have been tried and tested. There are some which have failed. So most people, if you had heard of Grofers, which was Blinkit prior to the acquisition when it was initially founded, at that time, Grofers used to work on a very different business model. Geomart also used to work on a different business model. What they used to try and do is you leverage the Kirana stores that exist in India today and solve for this purpose, solve for convenience. But that is something that has not worked. The reason being that it's very difficult to manage the inventory when the inventory is kept at so many different places, right? People may require something at point A, but to get it to point B can be a very challenging task or will be very time consuming. So it kind of defeats the purpose. So very quickly, what the business model for the quick commerce companies are. Most of us will know about this being users of these platforms, right? So initially, when you place the order as a customer, you place it on the platforms like Blinkit, Zepto, or even Instamart, and the order is assigned to the dark store in your within a 1 to 2 kilometer radius. The reason for that is to ensure the speedy delivery. So if you see, most of the deliveries are done in less than 15 minutes, and this is only possible if there's a dark store close to your location. So, and if you go to one of these dark stores, so at least Blinkit and Instamart, they show the app where the rider is coming from. So if you'll end up going to one of the locations of the dark store, you will see that there are at least 5, 10, 15 delivery riders just waiting outside the store. So the reason this happens is because as soon as the order is placed, within a minute and a half or two, your order has to be packed, given to the rider, and then the rider has to leave for your location. So only then can it be reaching your house within 10 minutes or 15 minutes at max. So at the same time, there is a invisible part to this business model, which is the mother warehouses. So these mother warehouses actually try and so they are the ones responsible for replenishing the dark stores either on a daily basis or every 2 to 3 days. So generally your grocery, your fresh produce is something that gets replenished on a daily basis, whereas the non-grocery items, be it from the beauty and personal care category, so all of those get replenished over 2 to 3 days. So the inventory turns also depend accordingly. So why is quick commerce as a model app primarily for the developing countries? My opinion is, so firstly, when you see the operations either at a dark store level or the final delivery of the goods, or even at the warehouse, less at the warehouse, but at least the first two a lot more, it's highly labor intensive, and access to low cost labor is very, very critical. So we'll see when we come to the unit economics as well, just how much the labor is as a total cost to to fulfill that particular order. Secondly, the supermarket penetration in developed countries is quite high. So this has led to some behavioral patterns in those countries. So in US, Canada, all of these countries, you'll see that there's a large Costco or a Walmart very close to your location. So, and they have a behavior pattern wherein every weekend or two alternate weekends they go purchase. So they have planned everything out, and this is something they've been doing for a long time. So if you see the penetration also, the population per supermarket in India, China, and United States. United States, for every 5 to 7,000 people, there's a store. Whereas in India, one large store will cater to at least about 40 to 50,000 people. And lastly, even if today we wanted to build these large stores in prime locations, it's difficult, right? firstly to get land, forget the cost of it, but to get that much land so that you can have all those SKUs for people, and also give enough space in the store so that people can come, browse, spend time, that becomes very difficult. And then the cost obviously adds on. Even if you find a location, the cost of it will be very, very high, which is why also you see that DMart has always refrained from coming to, let's say, a South Bombay or other such locations, because it's just not feasible. So coming to the revenue model of how the money flows from the user to the all the parties involved in the value chain. So there are three fees that are generally collected from the user. So you have the product level values, which is net of discounts. You are paying for the delivery fee, any delivery tips that you may be giving the riders. And then there are some convenience fees, platform fees as well. So all of these combined give you the total basket size or the order value that you'll end up having to pay. So generally, all these platforms give you a breakup of all of this. After this is collected by Swiggy, the delivery rider, he gets the delivery fee and the entirety of the delivery tips that are given out for him. And any additional fees based on how the performance is, how quickly he or she is able to deliver the goods, how many orders they were able to fulfill in a single day. So based on that, there are some variables as well. Then there is a merchant partner. They get the item total. So the merchant funded discounts net of whatever Swiggy commission. So basically Swiggy gets a take rate. So if you buy a good worth 100 rupees, Swiggy or a Zepto or any of these platforms will charge you will charge the merchant a take rate, which will be in the range of say about 10 to 15%. And lastly, so you also have some commissions that are retained by Swiggy. So some of the discounting happens at the level of the platforms, but generally a large part of it, especially in the food delivery side, are borne by either the restaurants or here in case of the brands that are there. And these platforms also have an incremental source of revenue which is different from your traditional format physical retail stores, which is the advertisement revenue. And this is a very important part of the overall business, and we'll see why. So this is the quick commerce unit economics. So there is some assumptions that I've taken into this, but the idea is not to look at each number very closely, but rather to understand where broadly the costs of fulfilling an order and how the profitability of these companies will shape up. So why is it that the promoters are saying that they can reach a 4 to 5% adjusted EBITDA margin? Where do they think that they'll be able to save costs from? So just to give you a sense, so I've taken Zomato and Swiggy, the first quarter from this fiscal, the numbers. So the monthly transacting users, so this is basically nothing but at least a user who's transacting at least once a month. The order frequency is, and this has generally been the trend, that each user on average is ordering at least 3.5 times a month. So that leads to your total order volumes, and based on the gross order value, you arrive at an average order value of 487 or 625 in the case of Blinkit. So within this 625, so that 625 itself is 19% of the value of the goods and services that a user is paying for. And 15% in the case of Instamart. So within that, if you take Instamart's case, roughly 10% is the commissions and the warehousing income that they get from sale of each product. So that is equivalent to the kind of gross margins that, so that is comparable rather, not equivalent, to what the gross margins of a retail store would be, a physical retail store. In the case of Blinkit, it would be slightly higher. If you were to estimate, it would be somewhere close to about 12-13%. Advertisement revenue, so these are assumptions. So, but there's a interview by Adit that says that the industry average in terms of the advertisement revenues is about 3.5% of revenues, whereas Zepto is doing roughly about 100 bips higher, so at 4.5% of revenues. Swiggy have taken slightly lower because they've had some execution issues. So, and we'll see what those were as well. But for those reasons, I've just taken a slightly lower number. But these are all, again, estimates. And this can really depend. And then you have some delivery fees, the platform fees. And we'll see. So, even today, if you see, 6 months back, Blinkit did not have any order fees, platform fees, or a convenience fee for any orders over 200 rupees. But now they charge a minimum of 12.5 rupees, irrespective of what your order size is. And then it can be higher if the cart size is really, really small. So from the total average order value that a consumer is paying, so about 625, Swiggy and Zomato land up earning about 120 or 72 rupees an order based on what products you're selling. So this can be different because of the share of goods that are being sold, whether it's grocery, electronic item, or a shampoo, depends on the products. But roughly, so this is something that has been there in the DRHP for Swiggy. About 46 rupees is what they'll end up paying the delivery riders on a per order basis. I've taken similar for Zomato, but I estimated actually to be a little lower because they are better in terms of their execution. And also, if a rider is going to, so in what helps with the dark store radius, the limited radius that is there, what helps is also the fact that because it's closer, the delivery rider is able to deliver an order much quicker compared to a food delivery, wherein there is no fixed point. So here, after delivering an order, the rider will go back to the dark store, and which is why also Blinkit generally keeps their the delivery rider fleet for a quick commerce business separate to a food delivery, so that you can solve for that speed. And when you do that, you'll end up having, say, roughly 2 orders that can be fulfilled every hour. At the end of the day, they want to try and, so at least in a metro city, the delivery riders land up earning anywhere close to about 17,000 rupees a month, which is a very respectable number. And this is only possible if, again, they solve for that speed and are able to fulfill more orders in a single hour. Then there are some platform funded discounts at Swiggy level. But then the other major costs that are there is, which is almost 8%, is the dark store costs, the cost of the warehousing, the mother warehouses, and some other variable costs and discounts. Yeah. So a large part of this dark store cost is related to the manpower. The entire delivery cost, which is again almost 10% here and 7% here, is the cost of manpower. So you can see from just 15% in the case of Swiggy, almost 10 plus, if you estimate even half of this, that's 14% going right there. So a very good percentage is going towards manpower, which is why it's essential to have low cost manpower, and which is why this works in India. So, one of the comments that Dipinder Goyal has said is that they can reach about 4 to 5% adjusted EBITDA margins. So, where do they think this will come from? So, these advertisement revenues, they believe, will reach roughly 6 to 7% of revenues as the demand on their platform grows, and there's a network effect which leads to a lot more consumers on their platform. The attractiveness of these platforms as a place for advertising your products, even for new products and established brands, will become even more. So that's one of the major places. And the dark store costs, the warehousing costs, these are a lot of fixed costs in nature. So as you fulfill more orders in a single day, you will end up optimizing for that and bring down these costs. So that will actually also help you improve your margins in the long run. And we'll see just a demonstration of that as well. So just some key indicators. So I can't really show a trend because it's only 2 years worth of data. But just taking Blinkit and Instamart numbers for FY23, FY24 and the first quarter of this fiscal. So how the gross order values have shaped up. So what was about 5,000 crores for Swiggy, almost 6,500 crores, has almost doubled. So the growth is very, very high. And they continue to say that they'll grow at least about 100% for the foreseeable future. So even in the first quarter itself, the Blinkit has done almost 5,000 crores, which is very almost similar to the entire fiscal of FY23. Yeah, the average order values. So this has also been increasing as more and more categories are available on these platforms. People are willing to try out and get the products from these platforms. In fact, even iPhones have sold on these platforms. They may be very small in number, but that is also a category that people have tried to list onto this platform. So one of the reasons why this number is very starkly different, and Zepto will be somewhere in between, is largely because of the share, the mix that is there at Zomato. So Zomato does a lot more non-grocery SKUs, whereas Swiggy and Zepto have focused a lot more on the grocery side of the packaged food business. Yeah. So how the take rates have been, so again, this is also increasing. Part of it could be the convenience fees that they've only just started charging, the advertisement revenues, and as their scale grows, their ability to leverage or rather command a higher, rather source the products from the brands directly becomes even better. So the scale really works in their favor. And if we take DMart as an example, they've been able to do somewhere close to about 14-15% kind of gross margins. So this is something we can keep in mind as to product level commissions, how they can potentially trend. So something interesting in the total number of orders that was there. So if you see FY23, Swiggy was actually higher than Zomato. And this was very surprising. So the entire narrative today, if you see, if you hear any analyst, if you see media articles, is largely that Swiggy has been bad in terms of execution, or they've lacked basically. If that is really true, then all it took was 1 year of poor execution, and they lost the plot entirely. And now the difference has increased so much that people are more or less writing them off. Zepto is about to become the number 2 player, whereas Instamart was probably one of the first that has been and the longest that has been around. Same in the monthly transacting users. So for some reason, which we'll try and explore and answer why later, is Instamart again had higher users on their platform in FY23, but they haven't been able to scale it up as quickly as Zomato has, or maybe even Zepto for that matter. What has been common across these two platforms is that the order frequency has remained more or less 3 to 4 times a month. So in terms of number of dark stores that are there, so the only way to fuel this expansion is to increase the density of your dark stores. And how they generally work is, if they're entering a new location, they'll try to service that location from a different dark store, which may be a little far away. But as you reach a critical mass for that region specific, then they'll establish a dark store. Now they may have, because they're in an aggressive expansion mode, you may see people just coming up with dark stores in different areas without actually having a market at this point in time. So a Blinkit in FY24, or rather even Q1 FY25, was about 639 stores, which they target that by the end of this year. So within 9 months, will jump to almost 1,000. So that is double of what they were in FY24. And in FY26, they want to achieve 2,000 stores. The same for Zepto, as per their media articles and interviews, is 350 in FY24, and they want to double it by the end of this year. In fact, it's almost like a race as to who can increase the number of dark stores faster. Because when the number for Zepto came out publicly, within a week we had, so this forecast was already there from Blinkit of 1,000 stores. But within a week, we had Dipinder Goyal coming and saying, okay, now we'll reach 2,000 stores by FY26. Something interesting from the Instamart in the DRHP. So they're at about 581 stores currently. And when you see how they're going to utilize their proceeds, a part of it will go to the expansion of dark stores. So the capex they incur towards that. So the numbers that they've given is only 10 stores by the end of this year incremental. So you'll be at 591, and they'll reach 1,000 stores by FY28, which seems abnormally low to me if the optimism around this industry is so high that why would anybody want to scale up be so conservative in scaling up. Again, a very important metric that one should track when looking at these companies is the number of orders that are being fulfilled per day by a dark store. On average, Blinkit is doing about 1,370 orders a day, and Instamart is doing about 1,050. This is important because when we look at the dark store unit economics, the profitability of a dark store for the dark store operator will depend on how sustainable and how much volumes can they fulfill in a single day. There are stores, as per comments from the management, that have reached 2,500 or 3,000 orders a day as well. Just something on the margins, and obviously this has been a loss-making industry, but that's also because the scale was really low. Now as the scale comes, you're seeing that improvement, and this has been much faster than the food delivery side, which is also why part of the optimism lies. So Blinkit is already at 4% contribution margins, whereas Instamart is still in a negative territory. And in terms of adjusted EBITDA, so what they adjust for is generally the ESOP costs, which are your non-cash expenses. So adjusting for that, Blinkit is already at a break-even level, and Instamart is still minus 11%. So, and we saw that they are spending more on a per order basis. When your AOVs are lower, you need to be able to, even to pay 45 rupees, which is the same if I assume for a Zomato or a Swiggy, as a percentage of the AOV, it is significantly higher. So you have to shell out a lot more when that happens. So very quickly looking at the dark store business model. So generally you have franchise operators or dark store operators are different from the company. So all the company, these platforms do is help in management of the SKUs as to what to keep and what orders to allocate to those particular stores. They also, so if you see Blinkit's website, they also appoint a store manager for each dark store. So that's the only level of involvement that they generally have. Plus the technology and the designing of the dark store is done by them. Plus the capex. So the entire capex is generally borne. So earlier, Blinkit never used to do this, but now most of these platforms are incurring the capex themselves. So this also helps them to maintain some level of control over the dark store operators. Yeah. Again, just some broad numbers, back of the envelope kind of numbers. So a dark store will require about 25 people across 3 shifts. And an average salary would be about 17,000 rupees. So you have 4,25,000, which is roughly half the cost of the entire dark store operations. The average store sizes are somewhere around 3,500 to 4,000 square feet. Taking cue from the DRHP for Swiggy, the rentals that they are currently paying is somewhere around 60 rupees a square foot. So taking that number plus utilities and other costs. So you also have your refrigerated items. So the cost of electricity over here can be really high. So that's why about 105 rupees is the total operating cost per square foot for a dark store, which comes up to so 2,27,000 is the store rent, and utilities is 1,40,000. The store rent, the number may seem a little lower, but it's also to keep in mind that these are locations that are not, on the main streets. They can be in some lanes, in buildings which are not that well developed. So it's not really in your prime locations. All it requires is that it be on the ground floor, and you have ample parking space for delivery riders, 10, 15 of them to wait for the orders that they have to fulfill. So the total operating costs are roughly around 8 lakh for a complete dark store. This does not include the profits of a dark store operator. That would be slightly over above. So maybe 9 to 10 lakhs is a good enough number to assume in this case. So then it entirely comes down to how many orders you have. So all of this is completely fixed in nature, right? You have monthly payments that have to be made for all the entire 8 lakhs. And the profitability depends entirely on how many orders you can fulfill in a single day over a month. So if you have 1,400 orders, which is somewhere close to where Blinkit is today, you need to be able to earn revenues of about 19 rupees per order that you are fulfilling. This allows you to break even. The higher this number goes, so if you go to 2,000, 2,500, then your profitability really starts kicking in. Generally, these dark stores work on a percentage of sales. So it may be around 2.5% roughly per order. So based on that, about 1,600 or 1,700 order volumes would be what their break-even level is. And anything over that is profits that they share with the platform as well. But there are some challenges. So it's not all that easy. If you can reach 3,000 orders per day for the dark stores, and that's what these companies are also claiming, right? So it would mean that it's a fantastic business. Let's open a dark store with these platforms and it's cash generative. You're getting paid by these platforms on a monthly basis, and you have to make the costs or make payments for these costs also on a monthly basis. So all you're getting is profits at the end of every month. But what are the challenges of being a dark store operator? So the upside is capped. You are working for a 1 to 2 square kilometer radius. You cannot go beyond that. The platform will not allocate those orders to you. And if you start seeing a lot of orders coming through onto your platform, there's a chance that a new dark store will open close by to help you fulfill all those orders. Because at the end of the day, these platforms have to solve for the density that is there in in that particular region, and therefore the demand that is there. So they don't have any non-compete for let's say a 2 square kilometer radius or anything like that. So your upside is capped. Demand, you're completely dependent on these platforms. So if the platform is going through a bad patch, because of whatever reasons they may be, right? you are the one that may get affected at the end of the day, because you have to bear those costs. The platforms may be very well funded at their balance sheet level, but these guys may not necessarily be. There is so competitive intensity. Everybody would have heard all the different brands that are trying to enter this space and compete for this market. Again, that at a region level, even if these new entrants they have some competitive intensity, and even if they're not as successful as these guys, but at a region specific level, those dark stores will get impacted for sure. And think of it more like a car dealership. The dealerships also have to be happy at the end of the day for them to keep selling new cars, right? At the end of the day, keeping that particular all the dealers happy is equally as important as selling a good product. So, dark store operator who is very, very efficient, because you have to pack these orders within half a minute to a minute, and package them, bill it, and give it to the rider. Ensure that you're not making any mistakes over there. It can be a very challenging task. So the break-even volumes, as we discussed on the last slide, can depend on how much. So if I'm getting 2.5 or 3%, let's say 3% as an example, 3% as a percentage of the AOV for a Instamart would be about 15 rupees. Whereas for a Blinkit would be about 18 rupees. That 3 rupees makes a big difference in how many orders I have to fulfill to reach break-even volumes. So even 2 to 3 rupees can make a big difference. Pilferage, theft, wrongful packaging, because these are execution related issues. Generally, at least based on the comments that I've seen so far, these risks are borne by the dark store operator. So you may get 18 rupees or 15 rupees per order, but at the end of the day, how efficient are you and how many mistakes you're making, that can also really define how profitable can you be as a dark store. So let's look at some of the reasons why there's so much optimism in this industry. So first is large TAMs, right? Total addressable markets. But what is really the TAM? So I've tried to answer this question, but again, I am not entirely clear myself as to what is the TAM, and I think that's a question that keeps evolving every year. But how these companies are looking at the TAMs, which do make some sense. So let's have a look at that. So the entire retail market in India currently is about 76 to 78 lakh crores. From which, so this is across grocery, fashion, electronics, pharma, beauty and personal care, and some other categories as well. From this, what Redsear's analysis says, 26%, so roughly 18 to 19 lakh crores is coming from your top 60 cities, 60 of India. From the 76 to 78 lakh crores, 80% is unorganized. And this is a play of a shift from the unorganized to the organized segment. So within, so that 18 to 19 lakh crore for the top 60 cities, the share of organized is obviously higher, but that is at 40%. So you still have a very large market which is in the unorganized segment, and that is what you're trying to solve for. Another way to look at the TAM, so in 2023, the size of the market was 22,400 crores, which was just 240 odd crores in 2018. So negligible at that point. The penetration as a percentage of total retail is just 0.3%. That's one way to look at it. And another way to look at it is you already have e-commerce companies. So online retail already exists in India. But as a percentage of that, you are at only about 5%. And if this is if this use case that they have is better than, say, Amazon, then maybe the share of this in the percentage of the total online retail should also increase. some macro tailwinds which is there for most of the retail stores, but definitely plays a part and will continue to play a part in the long term as to why these companies may keep growing. So the female labor force participation rate continues to increase. So it's increased to 37%. The number of nuclear households in India is also increasing. So when you have nuclear households and a dual income family, the time that you have to spend is a lot less. You want to maybe spend it at home with your loved ones and not go out to, just run some chores and things like that. So this makes it an obvious use case for these kind of platforms which can give you the products even if you've just forgotten something or just to save you time. So there are some advantages over a Kirana store also, right? So this is the segment that they're trying to shift from an unorganized to an organized. So the first is speed and convenience, which is very well established. In fact, in convenience, so this is day before I just opened Google Maps, and they have this nice feature where I can put in the destination and the starting point and also an estimate of what time I want to go. So I put it from CCI, which is here, to Churchgate Station, fairly close, right, at 7 p.m. Generally around the time where people start realizing and they're cooking, they forget something or they want some ingredients. So generally the rush hours, right? It'll take you by car at least 4 to 8 minutes. And in India, we all know that Google Maps is generally wrong. It's never the low end, it's always the high end. So this is one way, plus the fuel costs. So you're spending 16 minutes, you go there by car, you have to find parking spaces, which is another task. You're spending on the fuel. So all of this, or I'll just pay 50 rupees roughly and get the products delivered to my house in 10 minutes at best, right? Kirana stores operate with a limited operating hours, so they have to work. So they'll work, let's say, from 10 o'clock in the morning to 7 o'clock, 8 o'clock in the evening. These dark stores are available to you generally 24/7. So the reason that I had taken 25 people for a dark store, you will have, let's say, 10 people for 2 shifts during the day and half the number of people during the night. Because at night you may not have so many orders, but you still, which is why you can do with lower personnel at the dark stores. And this also solves for a lot of convenience. There are youngsters who like to stay up for till late, eat something or order something at night, even at 10 o'clock, 11 o'clock. When you come back home only from your working hours, which are very far away probably, you come home by 8, 9, eat, and then you want to order some stuff, your Kirana stores are already shut. At the same time, even if you have a Kirana store who's willing to do the deliveries themselves, sometimes you see that lands up taking a lot of time, even if it is very closely located. A platform like Blinkit can actually provide much better pricing than a Kirana store. So when I'm sourcing directly from the FMCG company, I'm saving on the entire commissions that are charged by the middlemen, right? So they are able to source at much cheaper costs than the Kirana stores. Also, the number of SKUs, so I forgot this point, but in a limited space, plus these stores are in a prime location, so and you need to have some space for walk-ins to come browse through the products as well sometimes. So they can only stock about 1500 to 2000 SKUs at best. But on a dark store, you have access to 6000 plus. This is at a single dark store. At a company level, they're already at 20,000, 25,000 unique SKUs that they have across pan India basically. And lastly, again, I don't have data to prove this, but my sense is you are solving for, basically there is optimum utilization of space in a dark store, because I don't need to have space for billing counters as large as a traditional retail store. I don't need people to come in and browse, just maybe one person who can walk, collect the stuff. I can build it as vertically high, things like that. So you are actually optimizing the space, which will lead to some better unit economics, therefore be more profitable than a Kirana store. So there is scope for more expansion. Currently, so if I take the population of just the top 60 cities in India, it's about 24 crores. And these are quite densely populated. So you will see in a 1 square kilometer radius, generally about at least 10,000 people, and it can be as high as 25,000 people per square kilometer. And from these top 60 odd cities, Blinkit has presence in 40 cities, Instamart in 43 cities, Zepto in just 11 as per the last available number that I have. But even if you are present across a lot of cities, that doesn't mean you actually have the dense network of dark stores within that city. So there is still a lot of scope for expansion within those cities itself. And as we said, the top 60 cities is 26% of the total retail market. And again, now this is not a point to for a bull case, but this lends credence to the hypothesis that there is use case and they're doing well. So some very well-known FMCG brands, Nestle, again, quick commerce in this has been the fastest growth in the e-commerce segment, and 50% of our e-commerce business today is quick commerce and is growing faster. You have HUL, which also talks about the same thing. Quick commerce is increasing. It is about a quarter to a third of our e-commerce sales at the moment, growing much faster. You have Dabur India, you have Parle Products, and Tata Consumer. So very well-known brands, everybody talking about this. We saw Neville Naronia's comments in the earlier slides. So there is definitely some value to this business model. But then if everything is so hunky-dory, then what can actually go wrong, or what are the challenges of running this business? One is you got to be very good at your execution operationally. So there are two things. So one is you can be a very good operator or an innovator. Here you have to be a little bit of both, but as an operator, you have to be even better. When you innovate, you may have a niche use case, which is what some of the new entrants will try to use to drive traffic onto your platform, onto your application, right? But after that, to have them stick around, you need to be able to solve the basic stuff, deliver in 15 minutes, good quality products, all of those things. So you have to be very good at your operational execution. And some of this is from at a dark store level. When you are now going into a phase of hyper growth, it becomes very tricky. It's not that easy. And we saw the numbers of Instamart as well. So in fact, if we look at this chart on the right, so from the Swiggy DRHP, if I in FY23, 24 and Q1 FY25, the blue column is the number of stores that were active at the start of that particular fiscal. The yellow line, sorry if it's not visible, but the yellow line is the number of new stores as a percentage of the stores that were open in that particular year. So how many new stores they opened in that year, which is a high number, yes. But what is more interesting to me is that the number of stores closed. So generally these dark stores have a 6 to 12 month lock-in at the very least. So you will not see the closures in a particular year stem from the new openings, right? So that's why I took the number of stores closed as a percentage of the opening store count. In the last 2 years, it's as high as 30%. So a third of your dark stores, if you're closing every year, with just 1 year or 2 years afterwards, it's going to have an impact because you have to solve for that and then also scale up in new geographies, new cities, compete with all the new entrants. innovate for new use cases so that more and more people come onto your platform. So there are a lot of challenges in terms of that. Again, I can't say for certain that this is one of the reasons that they've been bad in terms of their execution, because I don't have a comparable number for Blinkit, but it certainly seems like a question to ask. Location scouting becomes really important. You may end up paying higher rents, or you may be a little too far away from your target audience, which will take you a lot of time to fulfill the orders. For example, if you happen to have a store on the first floor, just going up and down itself will take the delivery riders. When you get you'll waste a couple of minutes there. So those things also need to be kept in mind. And profitability. And we saw the dark store unit economics. It is not that easy also as a dark store operator. In terms of SKU management, us consumers are not loyal to any single platform. If today I find that a particular product is not available on a platform, I'll immediately go and check it on the other platform. And even if it is available, sometimes I'll check where am I getting more discounts. So having all the SKUs present at any point in time is also a big challenge to solve for. And lastly, advertising income. So again, the kind of product mix that you have at your end can determine who wants to actually advertise on your platform, right? So a grocery player may not really want to, because you can't really brand that, brand which banana these are, or pineapple or anything like that. So those players may not want to advertise as much if you don't have the right kind of traffic on your platform. So, and it's a very important part of the business. If you take out the entire advertising revenues that even they're building in for the future, the unit economics fail. Then the increased cost of fulfilling an order versus a traditional format completely makes it a loss-making entity then. Secondly, you have all these new entrants. So you have Flipkart Minutes, JioMart, Ola is saying they'll try and do something through Ola Cabs. Big Basket now is already there. And you have three fairly established players who control roughly 90% of the market. So this competition may not necessarily be on just one front. So it may not necessarily be just I'm giving higher discounts. The capability of absorbing discounts is higher when you have scale. We saw that. So even just 10 rupees an order for a percentage of the AOV that you are charging, and therefore the overall GOVs can be much lower, right? So from that perspective, it's not just discounts that will drive traffic into your platform. You need to solve for a different use case. Generally, the perception is that a Swiggy or a Zepto is better, at least, than a Blinkit in terms of the quality of fresh produce. And Big Basket is considered one of the best for fresh produce. But Blinkit is very good for all my non-grocery SKUs. So you need to have your own unique strengths. Even all these guys have made it big in their regions. So Blinkit has been extremely strong in the north. So Delhi, Gurgaon, or this is where I think, if I'm not wrong, 40% of their entire gross order values comes from just that one location. And the top eight cities is also about 50 to 60% of their overall sales that they're generating on their platform today. Swiggy, Zepto, they're also strong in their specific regions. Now, when you're growing at such a high rate, you are expanding into all the other cities. So when you have more competition at a region level, then that is when you actually start seeing an impact on your numbers. If not your numbers, then your dark store numbers, which is the other critical part of this entire value chain, right? Second way is getting good warehouse operators, because you have to be really efficient on that front as well. Even a dark store operator, you cannot have just anybody become a dark store operator, because the more mistakes they make, yes, they will be loss making, but at the same time, the user experience will also be bad, and therefore the users will then probably shift primarily toward the competitor. So these are, and if as a new entrant, if I start promising these dark store operators maybe half a percentage point higher as a percentage of the overall revenues in terms of revenue sharing, they may get enticed. But what is also important for them is how sustainably will they get orders on a daily basis, as we saw earlier. So there are a lot of ways that new entrants can compete. I'm not saying no, but it will be challenging for them. 3 and 4. So one is regulation. So again, this is more of a hypothesis, but the conditions of these dark stores, how some of the produce or goods are stored. You see a lot of times when these goods come to your house, their packaging is a little bent, spoiled, or not really that great, right? So if there are regulations, so there are regulations today, but nobody is probably looking at this space that closely. So if that becomes a lot more strict in terms of how the warehousing is being done, that may lead to increased costs. So again, they may be able to pass on those costs, but that's a separate question. That is just one of the risks that is there. Investor behavior. So all of this, the entirety of this presentation is from an investor's perspective. So one of the things is, so if you see a Mint article, why are people wanting to buy Swiggy shares? There are a lot of questions that are there. Should I buy the shares? They're available right now in the pre-IPO market. It is a well-known brand. The gap between Zomato, which is 2.5 lakh crore, and Swiggy at 90,000 crores may reduce after listing, because the attractiveness of a quick commerce is well established. So with just that rationale, should I buy it? Personally, I'm skeptical of these kind of arguments. Yes, there may be value, but is Zomato valued fairly or not is a separate question. Is Zomato the one that is overvalued and Swiggy fairly valued, or is it the other way around? One has to really answer that. So this kind of investor behavior can really jack up the prices and lead to short-term gains, but in the long run, the investors are bound to suffer then. Yeah, so largely, if I have to summarize, yes, it's a large TAM business, but how large, one can keep estimating, because you're not only competing with the players I mentioned. Even D2C players are trying to solve for this. So Nykaa recently announced that they will also be entering into 10-minute deliveries. A lot of these D2C brands, or at least the premium products, will not want to list on these platforms. They'll want to keep their product offering very exclusive. So those are also challenges. So they're not the only players in the market. This is more of a mass business driven entirely on volumes. Advertising, as I mentioned, is an extremely important piece of the business. And one of the challenges is, yes, they think that it can become 6 to 7% of revenues. But will it grow at the same rate? Because I'm not earning the advertising revenues on a per order basis. I'm earning, and that growth is happening in that business as an absolute number. Then the number of orders fulfilled and the volumes I'm getting is a completely separate point. So on a per order basis, if then I calculate, is it actually growing as fast? And if not, then my profitability will keep getting pushed back. Execution is, again, you have to be very good at your execution and be able to gather that interest on your platform. And dark store operators, if they're not sustainably profitable, it can that can lead to a bad taste, and therefore fewer operators wanting to work for your platform, right? So yeah, so these are largely the points that I wanted to discuss. We can open for Q&A, and yeah.
Hi, very insightful presentation. Thanks a lot. So just to understand the unit economics of a dark store better, all the operating expenses are borne by the dark store operator?
Yeah. So it's the operating expenses that are borne by the dark store operator, but the costs that you have, so Yeah, the capex is done generally now by the uh, uh, platforms itself. Actually, what also happens is that the lease payments are done by the platforms only. So, in case of Swiggy, Scootsie does the lease payments, but then they'll charge the dark stores accordingly or give a lower percentage of the revenues in terms of revenue sharing that they have. So, those terms will differ. Where the capital commitment for a dark store comes in, generally, if all of this is just an operating cost, because there's no capital cost, there's no inventory that generally these dark stores have to purchase. So there's no inventory funding that is required. Those are financial investors that are owning the inventory. So both of these guys, at least, they are FII owned. So Indian rules for FDI suggest that you cannot be a multi-brand retail and own the inventory yourself. So you have financial investors, but the real commitment that these dark store operators then have to have is the deposits that they have to pay the platforms. And these can be as high as 60 lakhs, 70 lakhs, 80 lakhs per dark store.
So why would somebody with the balance sheet strength of, say, a Zomato sitting at 12,000 crore of cash rely on a dark store operator to manage their, operations? Why would they not do it themselves?
Which is correct. The reason being, it's not just about the balance sheet strength, right? Yes, they may be able to save whatever 2.5% or 3%, lead to better margins. But actually ensuring that each dark store is running as efficiently as possible becomes that's another big area to focus on. Whereas right now, if you see Zepto, if they're present only in 11 cities, but they've gone deep, whereas Instamart and Blinkit have gone for more reach across cities, then you are also trying to scale for that hyper growth. If you have to set up another 1,000, 2,000 stores over the next 2-3 years, scouting for those locations, getting people over there, ensuring all of the SKU management at the back end is done, how the mother warehouses are, all of this can become difficult. So where they are present to some extent, especially Blinkit, is managing the mother warehouses. So they ensure that that bit is done a little bit at least in-house.
So what is the selection criteria for these dark store operators? I mean, because in case they don't do a good job, the customer experience will be soured, and it's a platform which will get a bad name, right? So
correct. So again, I have not come across anything specific, but the entire tech base is given to these dark store operators by Zomato, right? So then if you are seeing a lot of dissatisfied consumers, you'll be able to track which location is majority of this coming. And then you can pinpoint which is the dark store responsible. So what are the kind of issues also matter, but at the same time, if it's coming from a single location, you can automatically understand that's a problem at the dark store level. So this is something that they can solve for.
Right. And how much did you say they break even at, the dark store operators?
So if I'm generating roughly around 17 to 18 rupees of revenue per order as a dark store operator, then they need to fulfill around 1600 to 1700 orders per day.
To break even.
Break even.
Okay. And last question, I mean, with the competitive intensity kind of, increasing, do you see the adjusted EBITDA margins for most of these players coming down? And in turn, do you see like the growth rates of the industry sustaining at this 40-50% CAGR that it currently is at?
So, yes, competitive intensity is increasing, but we have to see at a region level, right? If a JioMart or an Ola Cabs decides to launch in a geography where these guys are not there, it's not really competition. They are in the same business, but if I'm not even remotely in the same region, it's not really competition for me yet, till I decide to expand in those locations. But as scale increases, and one thing is that these platforms are, the advertising revenue is important, right? At the end of the day, the network effects will lead to that. And if I can solve for that, the other costs will keep coming down as I get scale. So maintaining that is more of a challenge. Maintaining demand at a region level is more of a challenge, in my opinion, than actually reaching the adjusted EBITDA margin. But yeah, it's a fair question. how sustainably can they maintain it at that 4 to 5% level after reaching it for the first time also will be something that we should track over a long period.
And the industry level growth rates, do you think they can sustain this 40-50% CAGR?
It is possible. So all the times, yes, I do think. So easy way to answer is yes. I think there's a use case, and I think it is better than a Kirana store in a personal capacity, right? Because of that, I am okay to say yes, they will grow at a high rate, at least for the next couple of years, maybe. But at what? At the end of the day, they're selling the products which have been around for a long time. So when will they hit that plateau? Very difficult to say.
Fair. Thank you so much.
Thank you.
So I think very nice presentation. But what's coming out is that this make or break or the success of a Zepto or the success of anybody like this is to a large extent dependent on these franchisees who are basically dark store owners. So therefore, there's a lot of shifting of risk. So they may have the best of technology. They may have figured that, everybody is okay to pay 50-100 rupees if he's getting a quick, fast service. But then, so that's a great idea, great platform, everything's good. But then your business depends on the fact that these guys make money. And for these guys to make money, they have to do those many orders and so on and so forth. So, again, they are not protected. That's also something that you said. That there is no non-compete. In 2 kilometers, you can have 3 stores because if there's so much of demand. So in that sense, I'm thinking that even if Zepto is a fantastic company and has the ability to be over a period of time, but if the dark stores don't perform, then they're finished. I mean, is that a fair assumption to make? Which is one. And the other thing is, very early on in the presentation, you showed something, how many supermarkets are there for the customer.
Correct.
Right? So I just wanted to clarify, this is a short one, but the dark store is a bigger one. Figure, is that an adjusted figure? Because in India, these figures are very funny because we're talking about 140 crore population. And then you say that 140 crores and so many stores, but maybe out of the 140 crores, 100 crores are not going to a supermarket, or a supermarket concept doesn't exist for them. So then is that an adjusted figure, or this is a figure based on the entire population of the country? So that is the second thing.
Just to answer your second question first, I think it'll be based on the entire population. It's not going to be adjusted for a specific metro city, right? So this will be more of a broad analysis. But largely you can say that in terms of the supermarket penetration, we are fairly under-penetrated. If I see in terms of number of supermarkets for that population in a region also. It's not like you see too many supermarkets. You will see a lot of Kirana stores. So the depth is there in terms of Kirana stores. Yeah. Correct.
50,000, only 500 are going to that supermarket.
Correct.
So that way the density might be really high. I mean,
fair, but that's the thing, right? So we've solved for both these issues. One is, yes, maybe people are not going to a lot of the supermarkets, but the reason they're not going is because you don't have something very close to your house. That's number one. And if I am going to a lot more Kirana stores today, I'm trying to show that this business model is already better than a Kirana store. So I'm actually solving for both the cases. Whatever the true numbers may be, it doesn't matter because I'm showing that I may be better off for at least specific use cases than both these formats. A supermarket will still be relevant if I have to do large bulk purchases. I want to do it at a discount. And if it is all planned, then I will still go to the supermarket. I will take that day out on a weekend and I'll go spend those few hours so that I can save a lot of money. So that remains true. That's the answer to your second question. The first question was, sorry.
The assumption that these dark stores are playing a very key role in the success of a Zepto and whatever projections they make, even if it's a fantastic model, but if the operators because they're taking there can be 3 stores around you. So tomorrow, if somebody wants to pick up a franchisee, but he's got no protection, and whether fulfillment of order happens or not, that depends on the Zepto platform or whichever platform. So it's a chicken and egg situation, that you should have enough orders to make sure that I break even as a dark store operator.
Correct. So rather, hello, can you hear me? Yeah. I don't think so. Even the platforms will be aware of the importance of these dark store operators, right, in the long run. So I don't think they'll unnecessarily build more dark stores in a very small radius. They know that at the end of the day, their success really depends on them. To what extent, and if they don't, then you will anyway see. See, at the end of the day, if you see ride hailing, if you see food delivery, not just in India, globally, these businesses have more or less turned into a duopoly. So if I have to capture as a platform a lot of this market share, even if this becomes a 3 to 4 player market in the long run, that's a sizable market that I may be catering to. So for me to be successful in the really long run, I need to take care of my dark stores as well, the operators as well. So they're not going to be completely dismissive of what is happening at the dark store level. The bigger challenge is if competition comes and in that small radius, then there are 3 dark stores all by 3 different players. And because of that, in a small region, you are not getting orders. Will, in that case, these platforms try and support these guys because there's more competitive intensity over there. Whereas at a consolidated level for these companies, they may continue to do well, they may be winning market share or anything like this. But at a region specific, will they be able to help out? To my mind, I don't know how much will they be willing to help out, but there are ways to help out. I can reduce the amount of deposits, and therefore the for them to earn a 20% return on investment, which is basically the deposit they're paying, comes down. So I basically have to earn the volumes can be lower and still they can be profitable. So these things can be done. The willingness, we'll have to see. Any questions on Zoom? Yeah, so there is one. Are the delivery partners part of the dark store count? I am assuming not, but are these captive? That is, during the day entirely do business with the dark store or quick commerce brand? Or is it like anyone can pick up the order? So to answer this question, yes, it is captive. So they have separate delivery fleets for the quick commerce business and a separate fleet of riders for the food delivery business, wherever the food delivery business exists in that particular company. Sorry, can I just see the question? Yeah, it's not like anyone can pick up the order. So, but it's also these riders are also part of the gig economy, right? So they can choose to work for only 4 hours a day for these platforms. So that still is very much the case, but you have to be enrolled onto these platforms, and you have a rider side app as well, wherein you show that you are online and willing to accept the orders. So, yeah. While food and grocery or staples can generally be considered recession or low growth resistant, quick commerce delivery in this space is not likely to be profitable at an overall level, and even more at dark store level, can swing very, very wildly when general consumer demand slackens. Yes, true. But what happens is when you have more grocery related orders, generally the norm is that a grocery SKU, you will have higher margins because you have to also account for the products going bad. So there is some wastage. So if your normal commissions on a product are about 10 to 15%, this may be around 20 to 25%. But your AOVs are lower. So it automatically compensates in terms of absolute terms. Do you see ONDC as a risk to Blinkit or Instamart, especially when government is concerned with the growth of it as it impacts Kirana stores badly? Yeah, so one thing that I did not address in my presentation is how would Kirana stores react to this, or can something be done? And ONDC, again, that model is still developing, I'd say. But one of the key reasons where I feel that it may not be as effective for a quick commerce model is because the riders will never know where they have to go and wait. So to reduce that time, if 10 minutes is the true value addition that you are doing versus if the products are delivered in say 30 minutes or an hour, that becomes difficult to do it in an ONDC setup because the goods may be available at a different Kirana store, which may be a little farther away as well from the location of the consumer. But again, how this will evolve, we'll have to keep track. So Ola Cabs is actually how they're trying to do this, or rather what their interview suggests is that they are going to leverage ONDC. So let's wait and see for another year or so what business model are they finally coming up with.
You touched upon it a little bit, but can you explain the inventory management a little bit better? You mentioned that financial investors take the inventory. Is it on the dark stores? Who takes the cost? There's obviously a lot of inventory costs involved in this entire process. So if you could explain that in a little bit more detail. Thanks.
Sure. So there are two things. Firstly, inventory is not on the books of the platform company. That's very, very clear. So you will see inventory levels very, very low in their balance sheets. It's especially because they are not allowed by regulations also to own these inventories from different brands. Like a multi-brand inventory is not allowed because you are FII owned. Secondly, you have financial investors. So what happens is a financial investor you will negotiate the terms with the FMCG brand, and a financial investor will just give you the money to procure that entire inventory. You decide where it goes, how it goes. So the entire management can be either you or you can outsource that also. But largely it is procured by these financial investors, or rather the capital is coming from there. How these financial investors are generating their returns. So they will get, let's say, 0.5% on the overall value of these products, which seems very small. But when you see the inventory turns, these guys are replenishing at least every 4 to 5 days. So your inventory turns land up being extremely high. They can be as high as 15, 20 times also. So when you are, the asset turns are that high, and you have a small margin business, you are able to make the required return on investment for those financial investors. And though they are also not bearing a lot of risk in the sense that if the product goes bad, anything like that, they are not the ones bearing the risk. It's just that the risk for them will be if the inventory turns or the demand slackens to a level that the inventory turns just don't come in. So even if the margins are stable, the inventory turns will effectively decide how much your IRR is at the end of the day. So that's where the risk for these financial investors lies.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.